Hi, as you surely know, there are several fundamental metrics for every single stock, from simple one like PE ratio, price to book ratio, to more complex one like Altman Z-score. However, not all of these metrics are created equal. Some are better to find good quality investment, while others could be detrimental to your investments. In this video, we will going to explore the best fundamental metrics to use to find good quality investments. The way we will do that is via backtesting. Backtesting is the process of simulating an investment through history and see how it did, for example, compared to the S&P 500. In this case, we will going to simulate an investment based on some fundamental metrics. So we will going to use this screener and backtest tool from long-term stock fundamentals. The idea here is that we can write an expression here, select which exchanges do we want. So for example, I selected the US exchanges, and then we can backtest it. For example, let's add a new condition. Let's say a profitable year count larger than 7. So it will select all the stocks that are at least $300 million in market cap and at least have been profitable for 7 years continuously. So if I click backtest, it will going to simulate the investing. It will simulate investing into S&P 500 every single year, and also invest the same amount into all the stocks that matches your conditions here. And then we can see here what is the return. So the median annualized return is roughly in line with the S&P 500 as expected, since we didn't really add any additional filtering here, and the average is similarly roughly in line with the S&P 500. And our returns are pretty close as well. So it's a little bit larger in the screener because we may have found some good stocks here, but roughly in line. So what we should do here is add additional fundamental metrics, filtering conditions, and try to get these average and median annual returns to higher values than the S&P 500. So let's add an additional condition here. Let's say the return on invested capital. I found this fundamental metrics to be quite a useful one. So let's add it with larger than 35%. So this is a very good return on invested capital stocks. And if we do a backtest now, as you can see, our returns have gone up. So previously we were just matching the S&P 500, and now both the median and the average is significantly higher. Okay, so next up, let's add something related to the financial strength of a company. I'm going to use the Altman Z-score here. So the Altman Z-score is a number to help determine the financial strength of a company. Originally, it was made to try to predict bankruptcy in companies. When it's close to 0 or even less than 0, that the chances of bankruptcy is really high. However, if let's say we want larger than 5, so very financially stable companies, and if we do a backtest now, so it was roughly 11% annualized return, and now we are up to 12% annualized return for both the median and the average. Next up, let's add something related to how expensively the stock is priced. So I'm going to use the trailing peg ratio. The trailing peg ratio is just the PE divided by the growth in the past 7 years. And in this case, I want, let's say 1.8. So this means that the PE ratio is roughly 1.8 times higher than the growth. So if growth, let's say, is 10%, then I am okay with an 18 PE ratio. And let's see our results. So it was 12%, and it got just a tiny bit higher. Next, let's make sure that we are not getting diluted. So if a company dilutes your shares, that means your ownership in the company is continuously decreasing. And that also means that the earnings per share will decrease as well. So let's make sure that the share count growth is less than -1. This means that the company is actually buying back more than 1% of their shares annually. So let's check the results. So right now we are at 12 and 12.4%. And if we check it now, then we are basically at a 13% annualized return. Now we still haven't added anything related to the growth yet, so let's do that. Let's say that the EPS growth is actually larger than 20%, so the company is growing at quite a fast rate. And let's see our results. So we are at 14.2% average annualized return and at 13.9% median annualized return, including the dividends. So next up, let's add something to the related to the free cash flow as well. So it's nice that the EPS is growing, but let's make sure that the free cash flow is also growing. So for mature companies, they tend to grow side by side, so there is high correlation, but for younger companies it can be quite different. Let's say here that it's growing faster than 10%, so I write 10 instead of 20 here, because the free cash flow can be a little bit more volatile, because it can decrease as you invest in yourself, I mean the company. So let's do a backtest now, and as you can see, now we are at 14.6% annualized average return and at 14.1% median return. So we are quite a bit higher than the S&P 500 using these conditions. So these may be something that is a good screener. If we click on the run screener button, we can actually see all the stocks that currently matching these conditions here. It doesn't mean you should buy them all, because you should do your own due diligence. Some of these stocks don't work out, so even if we check what these backtests actually invested in, we can see that sometimes it got quite a good deal, like in the year 2000, it bought the Adobe stock with a 14% annualized return. However, if we go down, we can see that sometimes it didn't work out as good. So in this Kato company, we only get 2.5% with the dividend reinvestment, and excluding the dividends, we were actually negative. We had a negative annual return. So if we go down, we surely can find even larger losses here as well. So for example, here at the Fossil Group, we basically went almost bankrupt. So we lost 94% of our investment, and you can just click on it and we can analyze what went wrong. So as you can see, the Fossil Group, it looked very, very good. So it was growing till 2014, basically continuously. Revenue, net income, EPS, free cash flow, everything looked very nice. And if you check the remaining of the charts, those looked very nice as well. But there has been some changes in the business environment, and it caused a continuous deterioration of this business. In this particular case, if you are curious, this has been a traditional watchmaker basically, and smartphones and smartwatches killed this stock. But as you can see, this is why it's important to do your due diligence. So if you see something that is about to disrupt the company, even if the company has a perfectly good fundamentals, it might not do so well in the future. So getting back to the original question, what are the most important fundamental metrics we should use to select our investments? I believe if I have to find one, this is the return on invested capital. That is the most important. However, these other ones which we have used here, like the Altman Z-score, the trailing PEG ratio, as well as the growth metrics, are also very important. However, you may also want to play around with this tool, because this is not necessarily the best screener out there. You can certainly use all of these other metrics to try to find even better stocks, and you can use this help menu to see what each of these actually mean. However, it's important to keep in mind that past performance is not a guarantee on future returns. So thank you for watching, and bye for now.